I'll just talk to the report we released last night on the retail sector. So basically, we took a look at the recent AGM season across the sector. We take a look at current industry dynamics more broadly, and also then we kind of delved into the LTI plans for most of our companies in our coverage, which was quite interesting. Okay, so we'll just start with where we've come from in calendar year 19 so far. So the retail index up around 30%, outperforming the broader ASX 300 by 8% over that time. And for reasons that are all very well known to us, obviously interest rate cuts, fiscal stimulus, election, and murmurings of the housing market kind of turning off the bottom. And just on the housing market, I suppose it's definitely turned. So we're up about 5% off the lows back in June, but we're still about 5% below the peak in the PCP. But increasingly seeing some better dynamics out there, although volumes are low. And whomever we talk to kind of say that those tighter lending standards are still having some kind of impact, but still good to see some turning off the bottom. If we move on to the next slide, this is a slide we report on constantly. That wide divergence, that multiples is still there. Obviously over here, the growth stocks that command a premium, and over to the left, those without growth or a couple of industry issues, but certainly seeing some value appearing at the middle portion of that band. Just again, where we've been this year, so that's the performance of all our stocks calendar year to date. Obviously, Levisa's doubled, Baby Bunting up 75%, JB's up 60%, Super's up 50%. So it has been a good year. Most of that has been PE led and not earnings led, aside from perhaps Baby Bunting in there. So just a reminder to be careful on what you capitalise, I suppose, in multiples. Looking at what we went through in the AGM season, it was an okay AGM season. Certainly no massive bombs, I don't think, from too many. Mixed top line updates. So I think broadly speaking, we probably expected to see a bit more acceleration of like-for-like sales growth, which didn't really come through. I think Super Retail and JB Hi-Fi reported an acceleration, and everyone else kind of a modest deceleration or a flatlining of those comps, which tells us that the fiscal stimulus certainly hasn't flowed through yet. Cyber events, and we talked a lot about this last year, so the Black Fridays, etc., and they're coming up at the end of November. They're now a thoroughly entrenched buying pattern for the consumer. And I actually think people defer their spending now until this period. So, in fact, we may not see people spend some of that fiscal stimulus, if indeed they do, until November. I would caution, and most CEOs will tell you that it really represents a pull forward of demand as opposed to any incremental growth. But I guess broadly speaking, coming out of it, I think the consumer's okay. They're probably a little bit worried about why interest rates are down here, worried about global machinations, etc. But I still think broadly they're better placed than this time last year, and multiples tell us that. Aside from JB Hi-Fi, most, though, did talk to tougher margins across their businesses. Everyone has FX to deal with. Most have put prices up. So when you see maybe someone report a 2% like-for-like sales growth, that broadly means they've probably put prices up 2% and volumes are flatlining. So just keep that in mind as well. Big ticket items still really hard. Cars, motorcycles are flatlined, but we've been in 3 years of downturn, so that to me tells you it's still pretty tough. And furniture downgrades from the likes of Nick Scali. So those big ticket items usually lag a housing tick up 3 to 6 months. So hopefully next calendar year we might see a better position from some of those retailers exposed to big ticket. In terms of the next catalyst for the sector, obviously that's February reporting season. Important to know what these stocks are cycling over Christmas and then into their trading updates. So if we just think over the balance of this calendar year, so what they'll kind of report over the key Christmas season, soft bases we'd highlight are being cycled by Bapcor, Levisa, Accent, Beacon, and Super Retail and its auto division. And then obviously once we're into February, the trading updates are very important, and that's where we'd highlight that there are some soft bases being cycled by JB Hi-Fi and again Beacon in that category as well. I'll leave you to read the note where those are cycling high bases. Just in terms of the recommendations we've made in the report as well, we put Domino's back onto a reduce from a hold, up close to 30 times now on FY20, forecasting 10% EPS growth. If you really pushed me on where I think the top end of their growth can be in the future, if they're really executing, I'd say 15%. So that's certainly not bad for a capital light, beautiful cash flow generation business. But it is now trading at a premium to its parent. I don't think it's completely out of the woods in some of the structural issues in Australia. But having said that, if they can really make Europe work, which I don't think I've got complete comfort in yet, but it can come at some point. You can see that growth profile accelerating, but a bit too ritzy for me here. Also put Beacon back onto a hold. It's put on 30% just since August. 15 times now seems fair to me. And again, that product is quite discretionary, but they are having a much easier base to cycle this year. Just in terms of our key picks, really, we haven't made too many changes there. For me, still Baby Bunting, Lovisa on a long-term view, and I've added Super Retail in there. We spent some time with the management team at the Investor Day recently, and that's not a turnaround business for that new CEO. That's around just integrating the four businesses and driving their pretty powerful 6 million active customers across or intra-division. It's a capital light model. It's got a really lovely yield. And he's well incentivized to grow this business now. So they'd be my three key picks. We also have ads on motorcycles, Adairs, AP Eagers, Accent, and 90B. Just moving on, we did quite a bit of work in this, just looking at the LTIs across our retailers, because most of them reset their LTIs at the recent AGM. So it tells you a good story on how these CEOs and boards are thinking about their forward growth profiles. I guess everyone incorporates an EPS CAGR into their performance hurdles for their option plans. And if you just look for a start at the midpoint of those EPS CAGRs on a 3-year view, and they're there and in the report, but in order of, the quantum of growth, you've got Lovisa 20%, Baby Bunting 15%, Domino's 16%, although that's the end of a 3-year plan for them, so they'll reset that this or next year and probably pull that lower, I suspect. Moto's 11%, Supers and Bapcor 11%, Adairs and Accent 10%. They're all quite big numbers. And if you look at my 3-year EPS CAGR forecast, none of them would get one option based on my EPS CAGR. So that tells you either I and the market are too bearish on the forecast, or the boards are too ambitious. And the truth's probably somewhere in the middle. No, not many of my retailers actually got many of their performance options last year, so that can occur. But also, I think it's it's poignant, I guess, to reflect on what these companies are expecting. The CEOs who are incentivized and able to do deals, I've got their Bapcor and Domino's. So I think, based on their organic growth profiles, they'd probably hit the bottom end of their EPS CAGR hurdles, and their industries allow them to do more deals and more accretive deals, and they're most likely on that basis. We also took a look at equity to FY19 salary ratios, which, tells you how much skin is in the game for these CEOs and how important their equity is versus their sometimes measly salaries. And they're all the founder-led businesses, obviously, like Lovisa, Domino's, Motos, and Apollo. But even the likes of, AP Eagers, Accent, Baby Bunting, and BAP have quite significant skin in the game, and therefore highly, aligned with shareholders. So just in summary, the sector has run quite hard, earnings growth not coming through to follow that up. That's a very familiar story across the market. Need to keep that in mind. But it is far more difficult in this sector to capitalise higher multiples, just given the cyclicality and, volatility of consumer sentiment and earnings. The LTIs of our CEOs paint a far more bullish picture than what us analysts are factoring in. Truth somewhere probably in the middle. We can't just invest based on pure consumer sentiment in this industry. Bottom up is so important. You think about Lovisa and Baby Bunting with market share appeal and offshore rollout programs, and that's why they command those higher valuations. So I guess, treading more carefully. Happy to trim some of those toppy positions, but key picks remain, Baby Bunting, Lovisa, and also Super Retail in there. We think there's upside from a PE and earnings perspective in coming years.